Most business owners look at sales numbers and feel confident, but real profit is decided much lower in the profit and loss statement. Revenue tells you how much money came in, but it does not tell you how much you actually kept. In this video, we explain how to create a profit and loss statement for your business using practical examples. Consider a small US-based business that sells industrial safety products and also provides related services to commercial clients. The year begins with revenue. Product sales generated $137,000. This revenue came from selling items such as safety helmets, gloves, protective eyewear, masks, and industrial tools to factories, warehouses, and construction companies. Product revenue forms the backbone of this business, but it also carries direct costs because products must be purchased, stored, and delivered. Alongside product sales, the business earned $34,000 from service revenue. These services included installation support, on-site maintenance, safety inspections, and annual service contracts. Service revenue adds stability because it does not require buying physical inventory and usually involves time, expertise, and labor rather than materials. In addition to core business income, the company earned $17,000 as interest income by keeping excess cash in a business savings account and short-term financial instruments throughout the year. The business also sold an old delivery vehicle that was no longer needed and earned a gain of $4,000 from that sale. When all sources of income are added together, including product sales of $137,000, service income of $34,000, interest income of $17,000, and asset sale gain of $4,000, total revenue for the year reaches $192,000. This represents all the money that flowed into the business before accounting for any costs or expenses. From here, the next step is cost of goods sold, which represents the direct cost required to sell physical products. The first component of cost of goods sold is inventory purchases. The business spent $17,000 purchasing safety equipment and industrial tools from manufacturers and wholesalers. These purchases are directly linked to product sales because without inventory, no products could be sold. The second cost is packaging and shipping, which includes boxes, protective wrapping, pallets, freight charges, and delivery expenses. These costs totaled $15,000 for the year. Packaging and shipping rise as sales volume increases, making them a variable cost. The third direct cost is warehouse handling and packing labor. Temporary workers were hired to manage inventory movement, packing, and dispatching orders, and this cost amounted to $4,000 for the year. When inventory purchases of $17,000, packaging and shipping costs of $15,000, and warehouse labor costs of $4,000 are combined, total cost of goods sold equals $36,000. Subtracting this amount from total revenue gives the gross profit. $192,000 minus $36,000 results in a gross profit of $156,000. This figure represents the money remaining after covering the direct costs of selling products and before paying for day-to-day business operations. Next come operating expenses, which are the ongoing costs required to run the business regardless of how many units are sold. The first operating expense is office rent and utilities. The business pays for office space, electricity, internet, and basic utilities, totaling $16,000 for the year. The second major operating expense is salaries and wages. This includes payments to administrative staff, a sales coordinator, and part-time support roles, amounting to $10,000 annually. The business also uses several software tools to operate efficiently. Accounting software, customer management systems, and cloud storage subscriptions together cost $100 for the year. Marketing and advertising expenses include online advertisements, basic promotional material, and outreach campaigns, which together cost $100. Insurance premiums for business liability coverage and vehicle insurance totaled $100. Professional fees paid to accountants and legal advisors for compliance, tax filing, and consultation amounted to $100. Office supplies such as stationery, printer, ink, and small equipment purchases added another $100. Travel and fuel expenses for client visits, local deliveries, and meetings cost $100. Maintenance and repair expenses for office, equipment, and tools came to $100. Finally, miscellaneous administrative expenses such as bank charges and small regulatory fees totaled $100. When all operating expenses are added together, including rent and utilities of $16,000, salaries of $10,000, and smaller expenses totaling $800, total operating expenses reached $26,800. Subtracting operating expenses from gross profit gives earnings before interest and taxes. Gross profit of $156,000 minus operating expenses of $26,800 results in earnings before interest and taxes of $129,200. This amount reflects how profitable the core business operations are before considering financing costs and taxes. The business also has a small working capital loan to manage cash flow during busy periods. Interest paid on this loan during the year totaled $4,000. At the same time, interest income earned from savings accounts amounted to $3,000. To calculate earnings before taxes, interest expense is subtracted and interest income is added, starting with earnings before interest and taxes of $129,200, subtracting $4,000 of interest expense and adding $3,000 of interest income results in earnings before taxes of $128,200. This is the income on which taxes are calculated. Using an effective tax rate of 6.85%, taxes for the year amount to approximately $8,718. After deducting taxes from earnings before taxes, the final net profit for the year is calculated. $128,200 minus $8,718 results in a net profit of $119,481. This net profit represents the actual earnings retained by the business after covering all costs, expenses, interest, and taxes. This is the money available for reinvestment, building cash reserves, paying down debt, distributing profits, or funding future growth. The full profit and loss statement for 2025 shows how revenue moves step by step through costs and expenses to arrive at net profit, making it clear how each business decision affects the final outcome. Now, let us compare the performance of this business between the year 2024 and 2025 to clearly understand what improved, what stayed stable, and what decisions actually drove higher profitability. In 2024, total revenue stood at $175,500, while in 2025 it increased to $192,000. This means revenue grew by $16,500 year over year. The biggest contributor to this growth was product sales, which increased from $127,000 in 2024 to $137,000 in 2025. This shows stronger demand, better pricing, or improved customer reach. Service revenue also grew from $31,000 to $34,000, indicating that the business successfully expanded its service offerings or retained more service contracts. Interest income increased from $14,000 to $17,000, showing that the business maintained higher cash balances or used better savings instruments. Gain on sale of assets rose slightly from $3,500 to $4,000, which is not a core growth driver, but still added to overall income. On the cost side, total cost of goods sold increased from $33,000 in 2024 to $36,000 in 2025. This increase is expected because higher product sales usually require more inventory, packaging, and handling. Inventory purchases rose from $16,000 to $17,000. Packaging and shipping increased from $12,000 to $15,000. And direct handling labor decreased slightly from $5,000 to $4,000, showing some operational efficiency in warehouse work. Even with higher costs, gross profit improved because revenue growth outpaced cost growth. Operating expenses show a very important trend. In 2024, total operating expenses were $27,960, while in 2025 they dropped to $26,800. Office rent and utilities reduced from $18,000 to $16,000, showing better space management or renegotiated rent. Salaries increased from $9,000 to $10,000, which suggests investment in people, but this increase was controlled. Most small administrative expenses reduced from $120 each to $100 each, showing tighter expense discipline across the business. Because operating expenses were controlled while revenue increased, earnings before interest and taxes rose significantly from $114,540 in 2024 to $129,200 in 2025. This indicates stronger core business performance. Interest expense declined from $5,000 to $4,000, meaning the business reduced debt or improved financing terms. Interest income increased from $2,500 to $3,000, further supporting profitability. As a result, earnings before tax increased from $112,040 in 2024 to $128,200 in 2025. Taxes remained at the same effective rate of 6.85% in both years, which means the tax structure did not change and profit growth was purely operational. Finally, net profit increased from $104,356 in 2024 to $119,481 in 2025. This year-over-year improvement shows that the business did not grow profit by cutting corners, but by increasing revenue, controlling costs, reducing interest burden, and maintaining discipline across operations. This comparison clearly demonstrates how small improvements in multiple areas compound into a much stronger bottom line over time.